Hi, I'm Steve Valentor from Polynomial Ventures in Chicago, and in this short video I want to highlight some of the features that can better align venture capital with universities. And as an entrepreneurship professor, I rely heavily on the SEC website. Its list of critical items for investors includes planning, risk tolerance, diversification, sources of investable assets, rebalancing, and fraud avoidance. Interestingly, rate of return is not listed. Most universities are seeking an aggregate return that exceeds inflation by at least 5%, though the Fed is making that increasingly difficult. Risk-free returns are safe and easy but won't achieve this objective. Higher returns are risky, difficult to find, and even more difficult to manage, and that's where we come in. While most endowments can tolerate longer investment cycles, they prefer flexibility. So consider evergreen fund structures. These are rare in venture capital, but they do exist. Our fund allows investors to redeem 10% of their assets under management each year, so they can frequently rebalance, be completely out of the fund in 10 years, or stay in it indefinitely. Management fees have a huge impact on returns. Over a 10-year investment, the standard 2 and 20 can actually result in a 60-40 split of the gains. Fund managers do need cash flow to be able to effectively look after portfolio companies, but it doesn't seem appropriate to charge management fees and carried interest. Once gains have been realized, the manager should treat any fees as advances and return them before calculating any success fees. We call our version 2 or 20, and it results in a true 80-20 split of the gains. Large universities get focused attention from VC giants. Smaller endowments are often relegated to junior associates. At Polynomial Ventures, you will be working directly with a partner. The best way to achieve gains is to buy low and sell high. 70% of early stage tech investments are made in Silicon Valley, and another 15% are made in Boston. This leaves the entire rest of the country competing for only 15% of the available capital. That's exactly where we invest. Early stage firms also need to draw mentorship and guidance from their investors. Outside of the tech meccas, experienced operators can be a statistical anomaly. We not only have the financial expertise, but also have been growing tech companies for decades. We apply a systematic approach for value creation that's based on an actual polynomial. And while describing it as outside the scope of this video, there is a white paper on our website that goes through it in detail. So more and more governance is mandating that endowments invest with RIA firms. While rare in venture capital, being an RIA goes a long way to earn the confidence of your trustees and advisors. Obviously, I could go on. What I'd really like to do is visit your university to meet with you personally. The size of the opportunity for both of us warrants it.